The fastest growth areas in 2021 we've seen have been the more thematic elements of our product range. So specifically the ESG offering that TAM has and the Sharia offering that TAM has. We've definitely seen a huge appetite in the market for clients wanting more thematic approaches, wanting an ESG portfolio. I think there's very much a feel from clients and their assets that they want to do more than just invest. They want to make sure that the pounds that they're putting to work in the market are having an effect outside of the stock market. That's a very powerful theme that we've seen in 2021. You see a lot of headlines coming out about ESG inflows taking up 90% of all investment over a certain period. We believe that that's going to continue into 2022, 2023, with the likes of Sharia portfolios increasing in size. Fundamentally, the Muslim investment market is underrepresenting the size of the Muslim community in the UK, and we believe that that's going to change. So we see a very exciting time in 2021 and 2022 for thematics, but also mainstream investing obviously will remain mainstream, it will remain core. And that's something to consider as well. Risk is also another factor that we've seen become extremely important in 2021. The observation of risk, the need to make sure that portfolios are properly risk managed. There's never been a time with markets at all-time highs and volatility creeping up. We need to make sure that managing a client's portfolio within their risk parameters is critical. And we've been doing a huge amount of work in 2021 and going on into 2022 to make sure that our risk management capabilities are much more robust.
The challenges for 2021 have been very interesting. What we're seeing in the industry is a great deal of pressure on margins for investment managers, for the financial advisory sector and finance as a whole. What TAM has achieved is to make sure that we've become and are cognizant of the FCA requirements of value for money. What we're trying to achieve is lower margins for us maybe, but more value for the client. In that context, we've reduced both our OCFs, the underlying costs of what we invest in. I'm very proud of the investment team who have made it life's work to continue to cut costs for clients. It's a very strong argument for using TAM. One of the key issues that we've faced in the industry is providing value for money for our clients. And I think we're achieving it with some style here at TAM. What we've done is reduce the costs of both our portfolios in terms of our AMC charging, but more than that, made heavy headway into reducing the costs that are incurred by others to us. And that's why the funds are at much lower pricing for TAM. Value for money is not just about investment performance or getting cheaper pricing. You have to do that in the context of controlling the risk in the portfolios. We've spent a lot of time working both internally and with external counterparties to do risk analysis on portfolios to ensure that we're not just delivering cheaper products, value for money, but within risk controlled mandates, which we take very, very seriously. We're looking forward greatly to our sales team getting out on the roads and meeting IFAs in their home environments again, which is something we haven't seen for a couple of years.
The challenges in the market for the remaining part of 2021, moving into 2022, I think are where markets have been so far. The trajectory of markets in 2021 has been nigh on parabolic. We're at all-time highs in Europe, we're at all-time highs in the US. Stock markets are very richly priced. Fixed income, government debt is extremely richly priced as well. What this does is it frames a challenge, which is that with markets so high, how do you continue to generate returns yet keep a properly diversified portfolio? And I think one of the challenges that we're going to see in the latter half of 2021 is creating that diversification for client portfolios, not concentrating into the equity market despite the fact that you've still got strong gains, because we are at such elevated levels. We need to make sure that capital preservation takes a very prominent role in portfolio management and risk management. So TAM's structured the portfolios obviously to be invested into the market that we're seeing, which is a very strong equity market. The equity positions that we have are broadly diversified across the US, across Europe and UK. with the main mantra that high quality companies are critical. This is a middle cycle environment. High quality companies we believe are going to be very good. We believe dividend paying companies are going to be very attractive. We've made sure that our clients' equity positions are invested into those areas of the market. In the short term, some of the headwinds that we might see in the markets oscillate around where we currently are in equity markets at all-time highs. We need to make sure that the portfolios are prepared for a drawdown. If the market sells off by 3, 4, 5%, maybe even 6%, we need to make sure that we have alternative assets to protect the portfolios. I'm very pleased with the performance in the portfolios. 2020 was a very good year for the portfolios. 2021, as we stand today, has been a very good year for the portfolios. We've outperformed our benchmarks comfortably with consistently lower risk, and that is fantastic for TAM. As we move into 2022, there will be some challenges. We need to make sure that the portfolios are prepared for that. They do oscillate around diversification, they do center on diversification, but where we stand today, the portfolios are in very strong position and we want to keep them that way.